My name's Nick Sawyer, Editor-in-Chief of Risk Magazine. As it happens, I started my career 17 years ago in the data space alongside a fresh-faced young Stuart Grant who's sitting alongside me and who needs no introduction. Alongside Stuart, we have Steve Swain, partner at Deloitte. Alongside him, Gerald Sampson, manager of financial risks and complex products at the FSA. And at the end of the table, Cubillas Ding, who we just heard from, Research Director in the Securities and Investment Practice at Celent.
The firm has to do a bit of thinking in terms of its actual needs from a risk management perspective, and it will have a different answer for trading positions in which speed and timeliness probably are a little more important than accuracy at any one point in time, although over time it has to be accurate. Whereas for credit portfolios, which presumably are the bigger bit, accuracy is extraordinarily important from the very first minute. So you have to start from that perspective.
I think what's interesting actually is that there's a big degree of overlap between what the regulators want and what banks actually need, what people need. So I think one of the challenges is actually, as has been the case with some previous regulatory changes, the regulation has good intent. Banks have good intent in finding ways to get value out of their investment, which is beyond compliance. It's a question really of whether that intent can be fulfilled or whether it will get compromised in what is a large range of regulatory responses that need to be complied with.
So I just want to draw quickly on one of Gerald's points about losing the reason for some of these reports existing. It reminded me of an example of a project we did a few years ago for one organization, which was a global bank with a significant investment banking arm. And they'd got to the point where their market risk reporting system was generating up to 400,000 reports a week. Now, I don't believe there's any organization out there that can consume that number of reports. But essentially what happened was when this system was originally put in place, somebody said, that's a great report. That's exactly what I want. And then somebody else came along and said, well, that looks like a great report, but actually I want 70% of what's in that and 30% of something else. And over time, we end up with several 100,000 reports, but nobody ever switched off the legacy element. So we were actually, we were able in that scenario to put in place an environment that enabled them to do more ad hoc, more on-demand drill down analysis, which meant that those several 100,000 reports went away, and the net result was that in that same time period, we found that organization was producing around about 30,000 ad hoc queries. But it actually completely changed the way that the bank operated because it was much more dynamic. Rather than those report periods taking an 8-hour batch overnight cycle, they were getting results to their queries on an intraday basis, which meant they could ask a question and then get a result and ask another question, as opposed to the question actually changing before the result is received.
The starting point is not what are you giving to the regulator. The regulator is actually not really the problem, although it's true that the regulators were in the room, but we were not the problem. The question is, what kind of data is in your system and how possible is it for you to tell me what is the total size of your mortgage portfolio, buy to let, 80% LTV? I want to know that. For any reason, it's a risk management reason, it's a regulatory reason, it doesn't matter. That's what I need to be able to do. So that, yes, will impact your source systems, and you're going to have to do a fair amount of analysis. But you don't start with a regulatory problem. You start with the slicing and dicing problem.
Yeah, I just wanted to add to that. I think the whole thing about risk aggregation, I think the process involved in how you're actually doing the aggregation is important because you have the numbers need to be credible. So that the process to articulate how the number is aggregated needs to be in place and it's communicated to the different stakeholders, including the regulators. And so when you say how far should I go back to the source system, it depends on how credible you think your process is and how far you need to go and how much detail you need to address. I think it's down to the banks themselves.
In the UK, we've seen in some organizations around about a third of their operations function being reduced from the levels they were at in 2009. But a lot of these organizations still rely on systems that were designed with bespoke capabilities, not standardized approaches. And so the ability to manage and support that is diminished. So before they can, a lot of organizations can actually move forward, they've got to almost unwind and relearn a large part of what's in place now before they can put the right foundation in place for the next 5, 10 years, whatever it might be.
We're talking about the timelines, and if you look at a lot of the larger firms, many of them, as a result of the crisis, have grown by absorbing a number of other institutions. So they're sitting on top of legacy systems, many of which are actually equally good, but they're not going to throw either of them out right away. So they've got a tremendously difficult task ahead of them, although I think it is probably doable. And in comparison, the smaller firms don't really have that problem at all. So it's all the more reason for the small firms to not sit on their hands.
I think we're eating into the next session. We're well out of time. It just remains for me to say thank you ever so much to the panel. Some excellent insights and opinions there. Thank you for your attention. Thanks a lot.